Hey everybody, good weekend. Here is your weekend report for Sunday, the 25th of June. Last week when we did this report, we talked about the market needing a little bit of a rest, and that's exactly what it's gotten this week. So for the past 4 trading days, the price has been generally drifting slowly lower. And now that we're down about 2.2% from the highs, people are losing their minds. And I'm seeing all kinds of things posted across social media saying, this is it. This is the end of the rally. We're going to be staring at S&P 3000 before you know it. And this is how markets climb the wall of worry, because everybody stokes the fear every time we see the very first red candle. So yes, it is a red week, but also notice what we had was weekly exhaustion. We had daily exhaustion, pretty severe. And so what I would expect to see is range expansion going into range contraction. That's precisely what's happening. It's doing exactly what it needs to do. Now, how will we know if this is starting to move into the bear? What I would say for right now is the maximum bullish outcome from this is if the price stays above on the cash index, stays above 4,300, so consolidates in a nice little tight range here between 4,300 up to 4,450. That is going to be the most bullish outcome from this. That would also show that the market is moving from this very chaotic bear back in 2022 into more of a stair-stepping type environment where range expansion leads to very tight consolidation, high and tight flags like this one, and then we would expect to see a breakout from there. Now, if it doesn't work that way, if we start to go below 4,300, if the coup over in Russia starts to put a bit more fear into this market, then we may see the price come down as far as 4,200. To me, that is the last line of defense for the bulls, because 4,200 was so hard fought. Any break back down into the 4,200 level or lower would be a big, big victory for the bears, and it would be a huge loss for the bulls. Now, notice that we also have fib retracements that line up with these levels. So if we take the March bank panic low back here all the way up to the recent highs, we're going to see that that 38.2% retracement comes in right around 4,200. Now, we could technically take a 50% or as far as a 61.8% retracement, but to me, this level here at 4,200 has to hold. Otherwise, if we do see a drop below there, then I'm going to expect or suspect that any rally back up is going to be false, is going to lead to a lower high, and then this entire thing might end up, this entire rally might end up being only a lower high, which would be even beyond the monthly chart reversal. So this could, in fact, lead to something lower, but I'm not going to go there just yet. Again, markets move in fractal patterns, and the first thing that has to happen is if we're going to reverse, it has to happen from the smaller time frames first, and that would start by losing 4,200 as a support level. But for right now, everything is happening exactly as it should. It's staying in a nice high and tight range. We'll see on Monday if this additional exogenous risk that's coming in from Russia, a little bit of red heat, is causing some problems in the market, is causing people to take risk off the table. We'll find out that fairly soon. Don't forget, we also have the possibility later on this week of a little bit of window dressing as we get into the end of the second quarter. That's it for today's Market Minute. Thanks for listening. We'll see you in the next one.